All right, everybody, welcome to our May 11th, 2011 Forex education class. This is a co-production between FXDD and FXStreet.com. Very glad that you could join us here today. You're going to get a great training from Greg. So our disclaimer is we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Okay, so this is a new and special training measuring and trading corrections in the Forex and precious metals. This has been a hot topic. Greg is going to cover it in depth today, and I think you're going to get a lot of benefit. All right, so there's Greg Michalowski on the left of the screen. He's our chief currency analyst at the company. Many of you know him from his speaking engagements around the world and his new book, Attacking the Currency Trends, which is out now. I'm Sean Powell, national trainer at FXDD. I will be along for the ride, helping out in the chat as Greg is presenting. We have a great contest going on right now. It's actually open to anyone with a live account. What you do is when you are making a deposit into your trading account, you're eligible for great weekly prizes and then big prizes like VIP tickets to one of the next Formula One races. If you didn't know, FXDD sponsors the Red Bull Racing Formula One team. If you need to get a trading account open, here is another special for you. What you can do is open an FXDD live trading account and then send me an email, spowell@fxdd.com.
All right. Thank you, Sean, and thank you, everyone, for coming out here today. I know the markets are moving, and as a result, for you to spend the time here with us is such a well, we feel honored to be able to do this, and we also want to thank the people at FXStreet. We had a little technical difficulties, but that happens in the world of these webinars. We have them time at certain times during our regular webinars, and I understand what it's like for them, but they do a tremendous service to everyone out there in the retail foreign exchange arena. So I'd like to make sure that they get their just deserving thanks for allowing this all to happen. As Sean mentioned, a hot topic of late has been these corrective moves in the currencies, in particular things like the euro and the precious metals as well, things like silver and gold. Silver in particular, and I want to focus on those two here today and talk a little bit about this idea of measuring the corrections and how you can really take advantage of corrective moves even though they are against trend moves. Today, a matter of fact, I got a email from a client. In fact, he's in the room now. He would be dandy Don out there. Don sent me an email, and he was querying about this idea of trends. I often say that traders have no choice but to trade with the trend. Are very high in that precious metal in relation to historical measures, but we're down rather sharply. In fact, we've had a nice little trend to the downside in silver. Same can be said. You have to trade with that trend. Otherwise, you're going to get hurt pretty hard. Now, it doesn't necessarily mean that you're going to trade with that counter trend forever and ever and ever. After all, it is, at this point at least, still a counter trend. Nevertheless, counter trends can turn into trends. So you always have to be aware. And there are things that the market tells you, things that through technical tools that you can follow, and we're going to kind of go through those things here today. Those little clues that the market gives traders that allows them to not only trade the trends but also trade the counter trends in a way that is almost logical. Okay, so let's see how it all develops here. But that is where we're going now. Trends. Why do we want to trade trends? And I say this often because trends are fast, trends are directional, and trends tend to have a high to low trading range that are greater than non-trending ranges. So if a market's fast, it's directional, has a high, low to ranges. What that means is traders can make the most money with the least amount of risk by trading trends, and that happens to be my mission statement. Those people who are familiar with my commentary will know that I set a mission statement for my traders and those people who listen to me and for myself, and that is just to make the most amount of money with the least amount of risk. And if you think about it, if you're trading with the trend, you are risking very little in your account. Why? Because your account's value should be growing, because trends are fast, trends are directional. If you're with the trend, your account balance should be going to the upside. So when I say that with the least amount of risk, you probably have the least amount of risk in your account value when you're making money. Doesn't that make sense? Of course it does. So what you have to do as a trader is trade. Be sure that you do trade with the trends. Now, by trading with the trends, traders also avoid a downfall of trading against the trends. And what people tend not to realize is that if you trade against the trend, what you tend to do is lose the most amount of money with elevated risk. Remember, trends are fast, trends are directional. So if you're trading against the trend, the market is going against you. It's going against you fast. It's going against you in a direction. And as a result, you have the best chance in the world to lose a lot of money. And in addition to that, your risk to your account balance is elevated. It's at a feverish pitch. It's at a high pitch. And so at high level. So what you have to do is really, you have no choice but to trade with the trends. Now, having said that, this thing called counter trends can be disruptive to a trader's rhythm and to anyone's account balance as well. And the thing with counter trends is you never know how far they're going to go. Where are these counter trends going to stop? And that becomes a problem for traders, especially when they're focused on, hey Greg, I got to trade the trend, I got to stay in this euro, I got to stay in this silver. But there are times where I throw that out the window and I start to think more in terms of, okay, let's not think about that trend. Let's think about this counter trend. But counter trends definitely increase uncertainty in traders. They also increase fear, and those people who know my analysis are always know about how I try to steer clear of fear. Fear is a trader's worst enemy. Anybody who has fear, not just in trading, in everything in life, if you have intense fear, you're not going to perform at your peak. So traders always have to trading in or having these counter trends can increase uncertainty, which can increase fear, especially if you don't recognize the counter trends and what the counter trends are saying. And it also puts into question your faith in the trend. It puts into question your faith in my analysis as well. So I want to clear those things up and hopefully show you what I mean by being able to see these clues in the market, being able to take advantage of these clues in the market that the market that it gives and allows you to actually trade the counter trends. So traders need to be aware and prepared. That's one of my sayings as well. Be aware, be prepared. It's a nice, easy saying. If you're aware, you're prepared. And it's also important to listen. Listen to what the market is saying. And that, again, is another visual that I have. I often look at a chart and I have the chart talk to me. The chart is saying things to me. I am not telling the chart what to do or the price to do. I am listening to what that chart is saying, and it speaks at me. I hear its voice. It says, we just broke a trend line. The market, the bias turned from bullish to bearish. Do something. Think about it. What do you want to focus on now? Where's the next target? Is that target reached? Do we get it through that target? Where is the target after that? And this is what I mean by the market talking to you. It talks to you. You have to listen to it. Take what you think, what your words that you want to put on that chart, that you want to say the market is going to do this or that because of this or that or that or that, and people on CNBC said that, and so on the message board said this. Throw it all aside. What you have to do is start to listen to what that chart's saying. Start to listen to what the tools of that chart are saying. And if you start to listen to it, you start to hear what the market is saying. Not what you're saying, not what the guy on the message board is saying, but what the market is saying, because the market's in charge of that price. The entire market. All the buyers and sellers are in there in an auction process, telling the market price where to go now. And if it breaks through a key trend line, if it breaks through a key moving average, it tells you something. You have to listen to what the market says. So it is okay to trade the counter trends. What I will remind you, though, is that to be sure, if you're going to take a trade against a counter trend, be sure that you understand where your risk is, where you are wrong. All traders always, the first thing that if you're working on an entry, what you have to always understand is, where am I wrong in this trade? Because in trading, you're going to be wrong more times than you ever thought you would be, and certainly if you compare it to other things that you may have done in your life. My wife's an accountant. She can't be wrong as many times as I am wrong trading, or as many times as you can be wrong trading. You have to be right in accounting. If you're wrong, you may have your client have a audit. The IRS may come after them. The IRS here in the United States may come after them and audit their tax records. So you have to be right in accounting. In trading, what you have to do is be sure that you define your risk. Get out if the market trend continues and the counter trend ends. And if you do that, then you'll be okay. You won't be necessarily trading against the trend. You'll have an opportunity, in fact, to get back on the trend. So you always want to be flexible. So with that introduction said, what I'm going to do now is I'm going to take the screen off here, and I'm going to bring up my charts, and we're going to take a look at the euro versus U.S. dollar first, and take a look at the recent moves in the euro versus U.S. dollar, and analyze that from a perspective of, hey, what was the market saying? What was it? What do I have to listen to in that market, in the market move? And so what you should see now is my chart of the euro versus U.S. dollar on a daily perspective. All right. What we know here is that the euro versus U.S. dollar has been in a nice trend. In fact, this low right here on January 10th was on January 10th. And we started off the year actually with a nice big four big moves days to the downside. But since this day on January 10th, the market has been in this trend, a nice little trend to the upside here. The trend, what I like to do in my charts is to look for to use tools. Use tools, in this blue line is the 100 bar moving average. This is, we're looking at a daily chart. This would be the 100-day moving average. The green line is the 200-day moving average. And if the price goes above the 100-day moving average, it's bullish. And if the price, well, in this case, the trend had really started down here, and so the 100-bar moving average was already above the 200-bar moving average. What typically happens is you break through the 100 first, like we did here. We formed a base against the 100, moved through the 200, that confirmed. Then we had this big correction, and we restarted the bullish bias right at this point where the market was below the 200. And actually, at this point, it was saying the euro should go lower. It should go lower. But we did find support against these old highs here at this area right here. We tried to break lower. We couldn't. We started to move back up to the upside. So once the market broke through this back above the 200-day moving average, it was saying, hey, this was a false break here. This has the potential to move back higher, and that's what the market did. It started to move higher. We broke above the 100-day moving average. Continued up from this level around 134 up to about 138.5, and then corrected down to the 100. And we had this consolidation retracement type period at this point right here. I like to use a Fibonacci retracement on the chart, and the market came down a little bit below 38.2, but you can see we formed a base. We started its move to the upside. But we're not about what happened then. What we do, though, however, is I want to take a look at this move to the upside here and show you the clues that the market was giving in regard to the trend, and because they have importance in regard to the counter trend. And so what you see here is a nice channel here. We were able to form that channel once we had these two lows in place. I could draw a trend line in there that connects this low to this low, and at that point right there, I have the ability to draw a parallel trend line. I'm going to take this off here and show you, exactly what I do whenever I have this a trend line or a higher low. I'm going to be looking to draw a parallel trend line. So I'll move this up here, and then I'll just try to fit in where this trend line should go. And if you connect this high to this high right here, again, we moved up, we made a high here, we came down here during a correction. We can draw a trend line. Now I can draw a parallel trend line up here, and quite frankly, you could have either drawn this line and put the parallel trend line down here, or this line and put it up there. But that defines the borders. That defines the guardrails, if you will, for this bullish move. And as you can see, as the market progressed to the upside here, we went right up to that trend line. And what do? We found sellers against that. Why? Because people could define their risk against this level. So if we were just at this point right here, and assume, let's play what if. I'm going to take this Fibonacci off here for the time being. But play what if. If you had this trend line in place and this parallel trend line across the top, would this be a level that you would consider taking profit if you were long? And I presume you were long because you had these opportunities to buy against this trend line. Would this be a level that you can take profit against? Of course it is. Why? Because if your risk is defined, if the market moves just this much above that line, it's probably saying from here to here, it's probably saying we're going higher. That's what the market is saying to me. It's saying, hey Greg, we're above the channel trend line. Time to get long of your trade, get long again. If you sold at this level, if it doesn't break above that line, however, what you can expect is a counter trend move, because markets just don't go up all the time. They go up in steps. And so what happens? The market starts to counter trend, and it comes down, and we come close to the line. We try to move up, and we come even closer to the line at this point right here. And here is another opportunity. Now it doesn't make it to that line, but what you did by getting out of your position here and following the market to the downside, you gave yourself an opportunity to get back on the trend, to get back on the main trend to the upside here at either this level or this level right here, where the risk is more defined. This low came in at 140.60. The trend line came, this low came in at 140.60, and the trend line came in at 140.14. So it's not exactly all that close, but you get this opportunity to get closer to that trend line. And what happens? The market goes up to this line right here, and then we have a situation where, again, you get that opportunity to trade the counter trend. The trend continues to the upside. You're long. The market has this ability to trade the counter trend, and it comes down here. Now, at this point right here, we actually break below the trend line here. So if you were to buy, if you sold up here against this trend line, you buy against this bottom trend line, you're actually thinking that the market has further room to the downside. But what happens? The market fails to ignite any additional momentum, and it starts its move back up to the upside. And that starts the next move to the upside. You can see what happens. The market goes up to the trend line, comes off, moves above the trend line. And at this point right here is important, because what you have to realize is that we're breaking out. We got the breakout that we didn't see at these 2 points or these 3 points right here, right here, right here, right here. We did not see any further move to the and right here. Did not see that break to the upside, but once the market broke up here, we were kind of in new territory. We were working toward new upside potential here. And during this phase right here, you have to be bullish. The trend is still your friend. We're not in the counter trend mode. But this is what I often look for, is for the acceleration through here, but at the same time, I am also looking for the failure. I am looking for the failure of the break. You always have to be looking for that failure, and that's going to give you important clues in regard to a counter trend. Think of it. You're moving along at a pace. You get to a point where it's very symmetrical. You're trading between the guardrails. You have a little blip below here, but it fails. The market closes back above and uses that level as a springboard to the upside. You get above this what is the comfortable region here, and the market starts to accelerate to the upside. This is still not a minor move. It goes from 146.89 to a high of 149.39. So that's a 2.5 point move, or I guess to the upside, 250 pips to the upside, not too shabby. So what, and also what do we get here on the corrective moves to the downside? We find support against the underside of this trend line. Look how this line came right to the support level, moved up. This line came right to the support, moved up. This line came right to the support and moved up. And we're making new higher highs and higher lows. So the trend is still intact. Would you all agree? Of course you would. The trend is still going higher. But we're not moving too fast here. And I have a line in here, 149.66, that also comes into play. It becomes into play because when you start to break to new upside levels, what I like to do is go back in time and kind of look at where the market was and what key levels were in play. And if I go back in time as I'm doing here, and I look back at that 149.66 level, and why I put that line there, I can go back to this high right here, and the market came off of it, moved up to that high, same high. We had a double high, and this is going all the way back to 2007, folks. So, but the market remembers, and the market looks for these levels. When the market broke through to the downside, what do? We use that level as a resistance now, and started a large trend to the downside. The next time the market was up at these levels, I'm going to zoom in here a little bit to show you. What you can see here is that we initially spent 4 or so days bouncing against that 66 level. Is the level significant? Yeah, the market remembers these levels. It starts to move above it, and then we move above it and we fail, and that causes a correction. Next time it comes up, it stays above those levels, give or take a few pips, moves above it. And you can see the importance of it. And in the market, when the market breaks here, we don't see it again until we start to bounce against it here. So we're above the trend line, we're moving toward there. So we have upside resistance that we know we have to get through. If we can't get through that level, then we're going to have some trouble, and that's what indeed what happens. So now we get to that counting. This trend may be over. This trend is acceleration of the trend is over, and that comes at this point right here when the market falls below this one level, the market and so we've moved to the point. That's where you're thinking. We just turned from bullish to bearish. Even though we're in the channel, we are now less bullish than we were when we were above the channel. And so you start to think in terms of a corrective move. If you sold at that 148 level right there, what would be your risk? If the market moved to, 148.20, how about that? Risk 20 pips on the trade. How many of you people risk 20 pips on the trade? A lot of you. So what you can do is look for that move to the downside. I'm going to demonstrate another tool here that I use as well. And you see there Fibonacci, and it's called Expansion in here. And what you do in a Fibonacci Expansion is you take a move, and this was the low that this whole trend to the upside started on January 10th. And if you move it up to the high price here, and then you take this corrective move and move that to the low of the correction, what this does is it measures where there is where you can expect the market to go on what is called an extension or expansion. And you can see, and what it does, folks, is it takes this range right here, and then it takes this low, and it takes the Fibonacci numbers of this low to high range, and adds it to the low corrective point right here. So as an example, this range right here, 100% of this range added to this low would equal this price, 144.13. Okay, you get it? 61.8% of this range would equal this level at 140.37. So when the market initially made this topside resistance here, what did we reach? The 61.8% retracement. So we had a couple of reasons why that was resistance. The market came off. The 100%, we consolidated around the 100, moved down, and then we got to this 150% of this range. So 1.5 of this range came up to the 140.06 level. Is that just below that signals that the market had some resistance up at this level, and in fact the market initially moved up toward that level, came off, made the new highs, and then used that 06 level as resistance. So we had a couple of reasons to think why the top was in place. breaking through this 148 level was another clue. Now let's go to the hourly chart here and take a look at the hourly chart while we're at that top. And this is where you start to piece together not only what's going on in the daily chart, but also what's going on in things like the hourly chart. And in this case, what we saw was the market moving to the upside. I have a lot of lines in here, but just kind of bear with me, I guess. In fact, I'll take out this line right here. These lines come in importance down at the bottom here where we are right now. But what you can see here is just like similar to the daily chart. We moved above the 100, we moved above the 200, we came down below the 200, the 100 here should go lower. Did not. We use that level as a springboard, started to move higher. And then we enter this consolidation. Trends turn into non-trends. This consolidation had, the reason why I have all these lines in here is because we go up to a high, we come down to a low, we go up to a high, we come down to a low, we go up to a high, we break, we should go higher, we don't, we come back to a low, we break to the downside, should go lower, we don't, we come back to the high. Look for these failed breaks. These failed breaks often tell you when the quote unquote trend turns to a counter trend, even in a non-trending phase here. And what you do is, eventually the market then, when we make our new high, when we go to that new high on the daily chart, we should go higher here. We should be moving at a momentum to the upside, but we're running against this 62 level, and then the market starts to come back down, and we break through the 100 bar moving average, and we also have this 148.07 level, which happens to correspond with these lows here, low here, low here, and we break through that level. And remember, off the daily chart as well, we had that 148 level. That 148 level was where that trend line this trend line was broken at 148. So things are lining up here to say we're turning bearish here. We're below the 100-hour moving average. Is that bearish? Yes. We're below the 07 level. Is that bearish? Yes. We're below the 148 level. Yes. Is that bearish? The next level that we have to get through is through this 200-hour moving average, which also corresponds with our floor here. If we get through that level, is that bearish? Yes. Can you see the amount of bearishness that is starting to enter into the market, even in a trending market? Can you see the shift from a trend? The hourly chart is really telling you non-trend. Something's going on here. What's the 100-hour moving average doing? It's going sideways. All these clues are starting to tell me, listen to the market. We are finding reasons to think that this trend is over, that this trend may have some difficulty continuing. And when the market breaks through the 200, when it breaks through this floor, it's already got its mind made up. It got its mind made up here when it broke through there. It had its mind made up when it broke through the 148. And it was just a matter of getting through this floor, and then it was all over but the shouting. And this happened right before the FOMC meeting on this day right here. And this is where the FOMC meeting came out, and it surprised the market. But you have to look for those surprises, especially when the market has this can go from a trending to a counter trending mode. Why? Because everyone is long. Everyone is long. The smart traders are getting short and pushing this market to the downside. And what better day to have it happen than the FOMC day? So that's what causes this correction, and then you start to move to the downside and start to move your way further and further. What are we in right now? We're in a consolidation phase of this move to the downside here. Is the bias still negative? Are we still in a counter trend mode here? Off the hourly chart we are. Why? We're below the 100-hour moving average. We're below, we allowed time in this consolidation here to have this moving average start to catch up with the price. And today we got, within earshot of the 100-hour moving average. This low came in around the 140, or the high came in around 23. The moving average came in about 59. That's the closest it's been since this point right here, folks. It's been a few days here, but this is what markets do. They consolidate, and they allow the 100-bar moving average. Are we necessarily continued on the downward trend to the downside? Well, there is a chance that in fact we could go lower here. Staying below that 100-bar moving average is a clue that the market still has some room to roam to the downside. From a long-term perspective, we started this trend going back to this low right here, and I am measuring out the corrective move down to the 140, 150. That would still keep the bias to the longer-term trend to the upside, but the counter-term trend still seems to be in the downward direction, staying below that 100-hour moving average. So we have a few more minutes. We started late, but I want to end make sure I end before the 12 o'clock Eastern time. So I thought maybe I'd take a look at the silver move to the upside and kind of do a quick review of that. We spent a little bit more time in the euro. Why? Because this is FXStreet. This isn't the precious metal street. But most people think that silver and these gold and commodity, or especially silver and gold, are commodities or proxies for currencies in this market. So we'll take a look at that. What I want to quickly do is take a look at the thing like take a look at the Fibonacci expansion, and I already have it in this chart on the daily chart. And if you look at this, we started this trend to the upside when the market was below this 200-day moving average. This is a daily chart. We went below the 200-day moving average. Just like we did, what we did in the euro, the market should go lower. Did it go lower? No, it didn't. It started to move back above that 200, start to use the 100 and 200 as support, and then surge to the upside. Now, the biggest correction of this entire move to the upside occurred at this point right here. So if you put your Fibonacci expansion from this high to this low, measure to the correction, and then start to use your Fibonacci expansion levels right here, what you can see just like the euro, in fact, exactly like the euro, initially the market found resistance against the 61.8% of this move to the upside. We found that resistance came down. And lo and behold, I mean, this looks very similar to what the euro chart looks like. We form a channel. The channel has a number of different points along it where we find support resistance. It's a trend to the upside. And like the euro, we also broke above that channel, saying, full steam ahead, folks. We're going higher. The bullish bias has just turned into a new gear. We should see this price go higher. But a little bit unlike the euro, silver really took off. There was a huge speculative demand in silver, and we moved toward the 149.50 level. We also moved toward the 138% Fibonacci expansion, very similar to what we saw in the euro. I think the euro was at 150, wasn't it? And so we found there was some resistance up here at 149.36. And what do we also know about the high in silver that we just reached? It reached the 31-year high in the price of silver going back to 1980 when the Hunt brothers started to tried to corner the silver market. That came in at 49.50, that high going back to 1980. I don't have that chart, but believe me when I say that. So not only do we have the Fibonacci extension, we also had the Hunt brother high at 49.50, and you can see the market moved up to that level, and we corrected. And like the euro, we corrected right down to the underside of the trend line. Is the trend still bullish above this line? You bet it is. It's still bullish, still going up, and we go up and we test that 50 level again. But on this day right here, what does the market do? It comes down to that trend line and breaks through it, and we come back and test it the next day on the corrective move to the upside. Now, what was support here becomes resistance at this point right here, and the market on this day actually does the entire range of the channel. We trade at the highs, we trade at the lows, we find support, we move up, and then the market breaks through the bottom end of the channel, starts its move down toward the 100-day moving average, finds support against the 100-day moving average right on the nose, move up, break through it, cannot close below that level, starts to move to the upside. Now we're starting to move to the downside. So if you are listening to the market in this particular currency pair, and in fact, let me take out this if you're listening to the market, you're getting clues that the trend is still bullish here. You're getting clues that the trend is still bullish at this point. You are getting clues that the trend turns bearish when we move back within the channel. You are getting even stronger clues that the trend could remain to the downside when it broke through this bottom trend line. And you were getting, but then you started to get a little more bearish news when the market was able to break through this trend line, but then it turned a little bit more bullish and moved up, and where do we go? 38.2% retracement. Now we're starting to move to the downside here in silver. So that's just a quick look at silver, but it shows a very similar pattern to what the euro dollar sold showed. Break of the channel, use the channel to define your trend, break of the channel, move back within the channel. There's something going on, folks. Start to look around. Start to find those, listen to those clues, and get on the right side of the market. Don't be caught in the counter trend moves. Even if the market is on a strong trend to the upside, there's always a possibility and the ability to trade these counter trend moves and or save you those losses from the sharp moves in a counter trend move that it could occur at any point in time. It also could reverse a trend as well. So that takes care of the program today. If there's any questions, I see there's probably some questions in here. Sean's probably answering some of them at the moment, but I will turn off my mic. Sean, do you have any questions? You can text me or whatever.
Stay in a counter trend trade when you're on the 5-minute chart. I know that's been coming up here over and over again, the theme of when the market is sideways or potentially not trending. How do you stay in? What do you do? What are you looking at on the phone?
How long do you chart? And what we see, I don't know. What we see here is the there's the same rules apply. The market was trending to the upside, and we are non-trending in this period right here during today's session. Now, what was kind of key in my analysis here today, I came in, when the market was somewhere around here during the New York session, is that even though the market fell below this floor here and made a new low here, low at this point right here. Actually, we can take this high here, take this high here, take this high here, and that's where this line came to play right here. And you can see when the market initially came down, what did we have there? We had the 200 bar moving average, and the ceiling, which is now a floor point there. So we can define our risk there. That's what caused this market to move higher. And then we broke through this 200, and we broke through the floor. But note here, the move below that floor level could not sustain any additional move to the downside here. In fact, we went back up to the floor, which was now the ceiling, and we tried to hold that level. That was giving the market a test. Do we want to go lower, or do we want to move back higher? And once we broke back above that level, that's where we saw the move to the upside. And lo and behold, we come back down to the floor level. These levels are they're visual. These people can see it. And we start our move down to the downside. We start to make draw this trend line in here, and then correct up just above the old key level, and then starts to move to the downside. And that was kind of the key here, where the market was in this non-trending period after a trend to the upside yesterday, where the market then started to think about trending more to the downside here. So you kind of follow the clues along. Traders could have, when the two moving averages here converge, and we're kind of getting into new stuff here from our lesson here, but when the two moving averages converge here, that kind of says the market is non-trending. Think about it, 100 and 200 bar moving average converging at the same price along with the price. That's what I call three's a crowd. That means that the market should look to move away from it. And the clues from this point right here, when the market came up to our high here, came back down below or to this 100 and 200, moved down to our floor, corrected up to that 100. These are giving you clues that maybe this market has more of a chance to the downside than it does to the upside. When it failed to move above this whole floor here with any momentum to the upside, that kind of sealed the fate of the euro today, and that's when we started to move to the downside here. So you see the lines that I have in place, and how far we go. Well, stay below the trend line is how I would look at it. I hope that answered the question.
Yes, it did, Greg. Actually, there was one more question that came in. This is from Woody, and Woody is wondering about channeling inside of a trend. When the price breaks outside of the channel, what's your take on the chance of that move being over? Hopefully that makes sense.
Outside of a channel, you have to go with it. What is it telling you? It's telling you that the bias turned from. So imagine that this is a channel here, this line right here, and this line. When the market breaks outside the channel, you got to say, well, we're going lower, or we should go lower. You just have to go with it. Now, sometimes it comes back and it moves back within the channel, like it did here. That's unfortunate, but that it happened. But if you're selling at this point right here, even if the market were to come back up here, you're not losing a lot on the trade. That's just trading. What happens in this case, however, when the market moves back above this line, what you as an analyst, you have this line here in place, this trend line in place. These lines are being drawn in real time, folks, as it happens. So when you break back above this line, you have to see the price move above this line in order to give you further confirmation that the next target is going to be this level right here. When it can't do that and it starts to move back below this trend line, this is the market taking the money away from you for, just because of it. But and the distance between here and here is not that great anyway. This line comes in at 48. This comes in at 59, so it's about 12 pips. So you may have squeaked through it and had your stop up at this level right here, if you're short at this point right here, and made it through. But who knows? That didn't necessarily do what you thought it would do, and that is do what it continued to move to the downside. So basically, the short answer is that if the market breaks through a channel, what you want to do is get out. Use those trend lines as reasons to get out or to go the other way. Well, we have 2 minutes, and so we got to finish this up. Carlos, 100 and 200 moving average are simple moving averages, so that's what I use for that. Greg never mentioned pivot points. I don't use everything. I use trend lines. I use Fibonacci's, and I use moving averages. What you're saying is pivot confluence gives a great trade. You are right. Confluence in any two tools give a great trade. I just choose not to use the pivot point. I use my tools and I get enough clues from them. I've warned people that too many tools can be dangerous to your health as well. You do have a point where you have too much going on. So be careful with that. But if you want to use a pivot point, I like that tool. Why? Because it's bullish above, bearish below, isn't it? And that's what all my tools are. Fibonacci's, moving average lines, and trend lines are all bullish above, bearish below. I call them unambiguous trading tools. If anyone has any interest in my book, go to attackingcurrencytrends.com. And that's where you can order my book. I don't know if that made it to the message board, but it's www.attackingcurrencytrends.com. Thank you very much. Thank you, people at FXStreet, Maud and Adinda and Vicky. Take care, guys. Talk to you next time.